Hi, welcome to the last mini lecture for Chapter 6, and we'll be talking about Learning Outcome 6-6 today, which is preparing and analyzing a merchandiser's multi-step income statement. And we'll be using both our notes and our worksheet to do a problem demonstration. So what is a multi-step income statement? Well, our notes tell us that the multi-step income statement format separates the revenues and expenses that relate to core operations from other peripheral items that affect net income. So let's take a look at an example. Now what I did on our notes here is I highlighted various subtotals. But I'd really rather look at this using our textbook page. So instead I'm taking the same information. It's just a little easier to look at because the print is a little bit more crisp and the color makes it a little more interesting and user-friendly. When you have more than 1 year represented in a financial statement, it's called a comparative presentation because you can then compare year to year to year. Notice that the most recent year is always listed first, with the earlier years listed to the right. So we are looking at Walmart Stores Incorporated, and these are multi-step income statements for the 3 years. First of all, notice that our income statement begins with net sales rather than sales. What we're seeing here is an external presentation. In other words, a presentation of our income statement geared toward external users, people outside the business. I'll show you in a moment what it looks like for people using the income statement inside the business. Net sales means that returns and allowances and discounts have been subtracted already. From net sales, we subtract cost of goods sold to give us gross profit, and we learned that calculation a little bit earlier. The selling price of what we sold is in the net sales account, and the cost of what we sold is in the cost of goods sold account. So gross profit is the amount that's made over the cost of your product. From that, we subtract all the core operating expenses. In this case, Walmart calls them selling, general, and administrative expenses. In some presentations, you might get the actual account details. Here, they lumped all the day-to-day operating expenses into one line. In their accounting records, they have listed all the separate accounts, but here they lump them all into one line. And they subtract those from gross profit to give us income from operations. So this line represents how much the company has made from day-to-day operating activities. Then they have another line called other expenses. And this represents expenses that are not related to the day-to-day activities of running Walmart. For example, let's say Walmart has a very big warehouse and the store next door wants to borrow some of that space, rent some of that space from Walmart because Walmart has extra space that they're not using. Well, renting out a warehouse is not part of Walmart's normal day-to-day operations. But that doesn't mean they can't rent some extra space to another local business and make some rental income. So that would be considered in this other category. It might be other revenue in that case. Interest expense is always listed under other expenses. So there are some things that are not related, some revenues and expenses that are not related to your core operations, so they would go below that income from operations line. You might not have these expenses every period because they're not related to the core operations. So if it's an other revenue, you would add it. If it's another expense, you would subtract it to get to income before income tax expense. And then we subtract out income tax expense separately to get to our bottom line of net income. So simply put, a multi-step income statement gives you several subtotals to highlight certain information on that financial statement. Now let me show you. This is page 283 in our text. And this kind of shows you the difference between external and internal reporting. For internal reporting, that would be this entire statement here. For people inside the business, we want our managers to know what sales revenue is before we had any returns and allowances and discounts. The reason is, if you experience a sudden uptick in returns and allowances, perhaps you're dealing with vendors who are selling you products that are not good, that need to be returned. And perhaps it might be that an employee is falsifying a return and keeping the money. So we need to keep an eye on our returns and allowances. And we need to keep an eye on our discounts, because these are, remember, price breaks that we give our customers for paying us early. This is money you're not going to be able to collect because you're allowing them to reduce the payment they're giving you because they're paying you early. The benefit of that is you get your money early and you get to buy more product, more inventory. The downside is you're not going to be collecting that $1,500, so you need to keep an eye on that as well. So sales revenue minus returns and allowances minus discounts gives us net sales, or sales revenue net. Now that's where our external presentation begins. People outside the business. We don't show them the other things because external users are on a need-to-know basis. By giving them that information, we might be tipping off our competitors. We'd rather not do that. Now, when you're doing your homework on the Chapter 6 Accounting Essentials document, I've given you a format that you can follow. Now, our textbook problems do not always follow this exact format, but hopefully it will give you at least a starting point. The internal user would begin with the first line and use this entire chart. External reporting would begin with net sales. Before we go on to our problem solution, let's take a look at one more thing. We said comparative statements are helpful because it allows you to compare that company from period to period. For example, gross profit. How much gross profit is increasing from period to period? The problem with looking at whole dollars is when you want to compare a company that's much smaller to Walmart, or even comparing Walmart to itself when there's significant growth, or when there's lack of growth and a company is actually making less money and taking less in net sales. The problem is it becomes difficult to determine if you're earning the same gross profit for every dollar of sales unless you turn this into a percentage. So now we're going to learn how to calculate the gross profit or gross margin percent. What we're going to be doing is taking our gross profit dollars and dividing by our net sales dollars to tell us the percent of profit earned on each dollar of sales. So, I apologize, we have a freeze here in our screen. Okay, the downside of doing these videos is that you can't always tell when your screen freezes, so I apologize. Let's take a look at that again at our comparative income statement. The way we figure out our gross profit is to take our gross profit dollars and divide by our net sales dollars, and that will tell us the percent of each sales dollar that ends up as our gross profit. And that allows us to compare Walmart one year to the next. It also allows us to compare smaller companies to Walmart. So we're on page 7 of our notes. I'm going to scroll out just a little bit. There we go. And there's our calculation. Our gross profit percentage is net sales minus cost of goods sold divided by net sales. And remember, net sales minus cost of goods sold is our gross profit. This gives us the percent of profit earned on each dollar of sales after considering the cost of goods sold. And it allows us to analyze changes in the company's operations over time, to compare one company to another, and to determine if the company is earning enough from sales to cover operating expenses. So if we take Walmart's gross profit dollars and divide by net sales dollars, our result is 0.243 If we multiply that by 100, we get 24.3% in 2015, 24.6% in 2016, and then 24.9% in 2017. So each year, Walmart is increasing its gross profit as a percent of every sales dollar. And just to make a point here, even just a 1/10 of a percentage point increase in gross profit translates into almost $500 million worth of profit because of the size of Walmart. Okay, now let's take a look at our problem. We're going to be using our worksheet here. Let's see, here we go. We're going to be doing problem 6-17. You can find this on Connect as well if you want to practice the same problem, and I believe it's a homework problem too. And I've already loaded in here our account titles. Okay, so it says the following data were provided by Mystery Incorporated for the year ended December 31st. And we've got all the information, and unfortunately they just put it in alphabetical order. We want to start with our net sales. That means sales less returns and allowances, less discounts. So let's calculate this above. First of all, sales revenue. I don't see any account here called sales revenue, but we do have two accounts called merchandise sales. We've got merchandise sales for cash and merchandise sales on credit. Now, if you recall through this chapter, we've never separated out cash versus credit sales, so we are going to add those two together. Both cash and credit sales get credited to the sales revenue account. Now let's subtract returns and allowances. I'll abbreviate that. And the sales returns and allowances are $7,000. I'm going to put parentheses to show a subtraction. And let's subtract out sales discounts. And we don't have any there. Okay, so no discounts. $282,000 minus $7,000 is $275,000. That's our net sales. The word net means something has been subtracted. In this case, returns and allowances and discounts. So that number is going to go on our top line here. Okay, now we need to subtract out the cost of what we sold to get how much profit we've made just on that sale. So $165,000, and you would not need to put the minus and connect, it would subtract for you. And that will give us gross profit of $110,000. So the selling price of what we sold is our net sales. The cost of what we sold is $165,000, and our gross profit, how much money we made on that sale before considering operating expenses, is $110,000. Now we have to subtract our day-to-day operating expenses, and we've only got two here: office expense and salaries and wages expense. So office expense is $19,000, and salaries and wages expense is $40,200. Add those together, our total operating expenses are $59,200. And again, I'm putting a minus just to show you that we have to subtract, but in Connect, I believe the formula is in there for you already. Okay, so $110,000 gross profit minus operating expenses of $59,200 gives us income from operations, our normal day-to-day operations, of $50,800. We have no expenses here or revenue that are not related to the regular day-to-day operations, so we don't need to add in other income or subtract out other expenses. We can go right to income tax expense, and that is $17,600. And that gives us net income of $33,200. Now, why do we subtract out income tax expense all by itself? Well, many investors like to look at how much the company is making from day-to-day operations by itself. because there may be special tax considerations for the company. Maybe they have an operating loss that they're carrying forward or backward, or perhaps a special tax considerations, including privileges they may have, maybe for the gas and oil industry. If we show investors the income from operations all by itself, it makes it easier for investors to compare companies. It tells you whether their core business operations are successful. Okay, now let's calculate that gross profit and gross profit percentage. We said gross profit is $110,000. If we take that and divide by the net sales, that tells us what percent of every sales dollar ends up as gross profit. Now I'm going to multiply that by 100 and then round to 1%, or I'm sorry, round to the 10th place or to 1 decimal place, and that gives us 40% gross profit. So for every dollar of sales, Mystery Incorporated earns 40 cents of gross profit. Okay, one more thing I want to point out before we finish this mini lecture is that problem 6-5 is also one of your homework problems. This one is a little bit different. It's set up differently because it does not total operating expenses. And that's fine. These are minor presentation issues, but I thought it might trip you up a bit, so I wanted to point that out to you. Have a great day.